So hello, everybody. My name is Maria Widner from Cambridge Finance. It's a pleasure to be here and talking to you a little bit about DCF valuations for real estate investments. I'm just going to start sharing my screen. So we have a presentation ready for you. Okay, so today the topic of this webinar is going to be DCF valuations for real estate investments. This is particularly important because even though we are trying to change the way we do valuations, especially if you're a red book valuer, is to go more into explicit methods, which is pretty much the DCF, discounted cash flows. So the implicit method is still very much used. If you are a valuer, you know what I'm talking about. It's still the principal method that we say in terms of valuation of commercial property, especially for investment purposes. But excuse me, but there is a big push now in order to align the practices that it's pretty much in the UK with the rest of the world, which is based on the explicit method of DCF. So the RSCS has put a guidance note out, practice information paper, and I was part of this review panel. I was part of the expert working group. But just said this disclaimer, this is my view only. I have, what the position of the RSCS is still pretty much that, the method is with the valuer's decision. That you are a valuer, you should know what is the method, what should be the applicable method. But as an industry, I think we will gain a lot by making the valuations more transparent. And with transparency comes confidence. And with confidence, of course, is going to, for our profession, it is a lot better. And for the property market itself is very important, because otherwise there is no way where you're going to know that, okay, is this value a fair value, or is this value the market value? What does the market value mean in terms of investment values? Okay. So just a brief introduction about myself. If you don't know me, I am the founder and the main trainer for Cambridge Finance. Cambridge Finance, what we do is we do a lot of financial analysis, a lot of financial models. We go to companies and we help companies, valuers, with their process of building models for valuations, investment purpose, but also red book valuations. And my love is, my passion, I always say, is to teach as well. So not only we build models, but we also teach the models and what is the meaning behind those models. Because I don't want you just to get a tool and make decisions based on the output of this tool. I want you to understand what is the actual tool telling you, and what is the intricacies of any investment decisions that you make, or even the values that you put in front of your client. What does it mean in terms of what are the economics behind it, what is driving the values, and what are the risks in this value as well. So it will be a way, so the models are a way for you to tell the story of the valuation with a lot more transparency. Okay. I am also the founder CEO of Real Estate Women, which is a diversity networking group. And I am a very big advocate for diversity in our industry, diversity not only in terms of gender, but also ethnicity, sexual orientation, economic background, and disabilities. And the whole diversity and inclusion is very important for our industry as well. So knowledge and diversity are my passion. So as I mentioned, I was part of the RCS DCF expert working group that published the main guidance for the DCF valuation for investments. So I was part of the background conversation, how it came about. But again, as a disclaimer, I wanted to make sure that you understand that this is our professional opinion, and it is a little bit aligned with what RCS is doing, because we were part of this conversation. But just so you know that this is sometimes what I would say may conflict, so then you know that this is my opinion only. Also, I'm an associate professor at a university in Spain, and that's me. So welcome to the webinar. Right, so what we're going to talk about today. So today the webinar is going to be a little bit longer, because what I want to do is talk a little bit more in terms of the theory behind the DCF. What is that you need to know now in terms of valuation from an explicit method perspective. And also I want to discuss the DCF inputs, where those numbers should be coming from. Is it market value? Is it investment value? What is the difference? And how, you know, we are going to use a model, how the models should be working for you to give an opinion of value, or an opinion of, is it worth my investment? Is it worth you putting your money in there, the investment value? So I hope that's I hope that's helpful for you, and you stay there on this webinar. We're going to use, it's not going to be a hypothetical case study. It's going to be a case study that a building that is already in place, okay? But we will use a case study in order to look at this valuation, the valuation practice. So let's start. Again, if you have any questions, please put them in the Q&A. Happy to answer any questions. If we don't have time to address your questions on this webinar, I'm happy to follow up afterwards, okay? Right, so in terms of what the paper is about, I'm not sure if you all have read this guidance note of that the RCS has published just very recently. So discounted cash flow valuations, that's pretty much from an investment perspective. So everything that there is I would say there is a separation between the landlord and the tenant. There is a separation between the owner of the building and the occupier of the building, okay? Therefore, this should be based on discounted cash flow valuations, and this discounted cash flow valuations, the reason why it was the RSS is putting more weight on DCF is because it follows from the previous paper on investment valuations that was done by Pereira Gray. My name here is written incorrectly, but that's me nevertheless. And then the main writer of the paper was Neil Crosby from Henley Business School. So this is the paper that you should be aware of, especially if you are a valuer, red book valuer, or even if you are a surveyor and you are doing valuations, even if you're not registered. It is very important that you take a look at read the paper and try to, you know, come up with your own conclusions and be, you know, aware of the changes. It's not so much the changes, but it's pretty much the clarification. So that's why it's a practice note. Okay. So what we're going to talk about. So this is the whole paper. So there's a lot of glossaries. There's a lot of, it's quite good. It just tells in detail what we've been talking about on the background. Right. So let me then go back here. So on the DCF status, so if you are a valuer, you're thinking yourself, okay, do I need to use the DCF now? And if you haven't used before, the red book says that there is no red book method. And that's very much the RSS position that they say, okay, you are the valuer, you should be capable of deciding what is the method that you should use. So everything that we once started with, you know, you have to do it because that was the recommendation that we use the explicit method for evaluations. it is pretty much left on, your decision if you're going to use the DCF or not. That's absolutely fine, but you should not hide behind the implicit method, okay? So if there's one recommendation here is that if you're using the implicit method, what we call the all risks yield, don't hide behind all risks yield, because I know that it's a lot easier to use all risks yield. I am valuing myself investments. It would have been a lot easier to say, okay, everything is in the yields. So if there's vacancies in the yield, if there's capex is in the yield, if there's rent-free is in the yield. Because the yield has everything, it has nothing at the same time. So you can't really detangle, you can't really show transparency in your thinking, okay? You can just say, well, that building was sold for a yield of 5%, but that doesn't tell anything about it. It doesn't tell how this comparable really relates to your building. So you need to be very aware of what is the comparable. Does it really compare or not, okay? So make sure to add DCF to the valuations and discuss the input. So I think like the starting point is, even if you're doing the term and reversion, the hardcore method, you are using the very rented kind of assumption. Now you will have to be a little bit more explicit, and you have to start thinking about what is this DCF? How do you discount this cash flow? Again, it's about providing transparency, okay? It's about providing more information than less information. And as I mentioned before, don't hide behind the just comparable, the yields, because that doesn't tell the whole story of the valuation. We need to go through a deeper analytical process these days in order to provide robust opinion of value. Right. So let me just start here with the implicit all risks yield. So where we were before, or sometimes we still are, is this idea that we are going to do the valuations based on this implicit all risks yields. And this chart here is one that I put on the paper. So it's appendix number 1, okay? And this is the REC rented property as capitalization method. So what would you do is just, you're gonna say, okay, the market rent, the effective market rent, and even the effective market rent has a lot of assumptions in the effective market rent. And then you are going to divide this rent by a capitalization rate or a yield, okay? And then this will come up with a value. So this is the scenario of the implicit method that was very criticized, I think, in the paper about the review on investment valuations. Now, what's going to happen? We will have to move from this assumption of just like a straight line into perpetuity, because that's the assumption of the rent divided by the yields here. The value is the rent divided by the yields. We're going to have to move from this assumption of rent divided by the yields into perpetuity to one of an explicit DCF, okay? So how do you go from here to here? There will be a lot more assumptions that we need to make, okay? So we'll have to find out what is the assumptions and how do they relate to the market, if you're doing market valuation, or how your investor or how your client is thinking about those assumptions. And you'll have to find out how they are thinking about these new assumptions in order to provide a robust investment value or worth valuation, okay? So in this DCF here, in this net cash flow here, I excluded the sale value at the end because the sale value really distorts this chart. But it's the idea here is that you'll have to find out what will be the ins and outs of your cash flow in order to bring everything to present value. So that's the idea of discounting the cash flow, because you bring everything to present value. And all those inputs here, they are not the same as the capitalization method. Will need to be thought through a little bit more. So as you see here, is not only a straight line, you have periods here where you have very negative cash flows, and you have to think, well, how do I go about discovering what this negative is? So it's the exercise of price discovery, and it's pretty much the discovery of what should be the assumptions that should go into your cash flow. Okay. Now, with the implicit valuation method, what we always need is an assumption of rent and assumption of yield, even if it is the passing rent or the market rent. But we need this assumption of rents and the assumptions of yields. And then normally the yield will say, okay, this is the relationship between the rent and the price that was sold in a comparable input. Now, with the explicit DCF inputs, we have to think a little bit further. What would we have to think about? So I've classified the inputs. This is my own classification here as a disclaimer. Again, this is not the RSS, but this is my classification here of what is going to be your challenges now going forward for you to find what is the explicit DCF inputs. So I put in green here because the green is what we are used as value to use already. So in terms of rents, we have the passing rent and the market rent. So you're thinking about those inputs already. And also putting green the OPEX, because if you're going to do this valuation, you have to be aware of what are the operating expenditures of your cash flow. So if your rent is already triple net, for example, if it's an FRI lease in that the rent is a net rent, then the OPEX should be minimal in time when you have a void. But because in the implicit method, we don't, the void is implied in the yields, then the OPEX is not very thought about. But if your rent is a gross rent and you have to deduct costs, then you have to think about what is this leakage. So these are things already that even with the implicit method, we're already thinking about. And the market rent, the ERV, we already thinking about what is this ERV already. So and normally what we do is that we capitalize this ERV. I'm gonna open here the question. So I have a question here already from Khalid. Nice to see you again, Khalid, virtually. The question that Khalid has here is, when all risks yield appropriate? Well, we had this conversation in the panel, and then I would say never, because what they said is like the fish and chip shop in a very small town that is just gonna pay one rent forever. There is no rental growth. There's not much lease event, and there is going to be there's no vacancy there, or it's very simple. But I don't think that's an accurate way to express this. I think what they were saying is that if the value of the property is very low, then it's okay to be more broad with your assumptions. Not going to spend so much time and effort doing this valuation, but I don't think this is a correct way to put it. So what I would say is that if it is an investment, i.e., if there is a separation between who is the owner and who is the occupier, there is never an appropriate, I don't think that's appropriate for you to do an all risk yield. Again, this is my view. If there is an income, there is a way for you to find out or make assumptions regarding what you think the cash flow is going to look like, because you will have to assume that this tenant is not going to be there forever. There is going to be some these events, they're going to take place. So there you go. Okay, hope so my answer is never. But it's never, it's always quite hard to say. Maybe in commercial property, I would say never. If it is residential, maybe in the residential side, because there's very low risk of the tenant moving out, is just a single tenant, then it might be that you can use all risks yield. But in commercial property, I would say never. Okay. The yellow here is these are now inputs that we have to start thinking a little bit more. So what are those? The growth rate, okay, so the market growth rate. So what do you think or what the market thinks? What is the implied assumption? We still have implied here because it's a market implicit assumption of growth rate. What do you think is the growth rate? Okay, it's going to be with the growth rate, with the market growth rate of your market rents. You also have to think about depreciation and obsolescence. Okay, so we have to think about, okay, there is a good graph that you put on the paper. I'm going to show you here, which is the relationship between this chart here. So it's the rental value, rental growth in line of properties in the location and the existing property, because the existing property might be that might be obsolete. So if it is a new property, your rental growth might be stronger than if you have a building that is already suffering from obsolescence and depreciation. So it's going to be lower. So you have to think about not only the rental growth, but you also have to think about the rental growth and the depreciation. What is going to be the relationship? Because your rent might not grow at the same as in the area you're in, because your building is already depreciated. There is also this impact of refurbishment. What are you going to assume in terms of refurbishment? Are you going to assume any refurbishment? In my case here, what we assumed is that there is a refurbishment. So there is capital expenditure at this point in time, okay? And then is this what we should be doing? So you as a value, you have to start thinking about, is this what should be doing or not? And then you have to think a little bit harder about the lease events, because until now, lease events were implied in the effective rent. We're gonna say, okay, there is a, the market rent is 100, but you have to think that there is a void period of 6 months. You have to think of the rent-free period. There might be like capex contributions for the tenants, and that will get you to an effective rent. Now with the DCF, all these inputs can be a lot more explicit. So you have to think about the lease event. So what is going to be the void period? What is going to be your assumption for breaks if there is a break in the lease, do you always assume that it's going to break or not? So you have to have this view, because you don't need to break all the time your lease. If it is very built for a specific purpose, if you think the cost of moving out for the tenant is greater than staying in, you don't need to break the lease. You don't need to make this assumption. So you need to have this further thinking, this further analytical thinking, in order to say, okay, it's going to break because of this, it's not going to break because of that. And also the rent-free periods. What is the market rent-free period? And all this then might be, you will say, okay, then this is going to be explicit in my cash flow. Therefore, I'm going to use the market rate, the headline rent that is already there, or I'm going to make assumptions for those tenant incentives, and then come up with an effective rent. With the effective rent as well, you will need to come up with an assumption. Why? Because if you have rent reviews to market, this rent review to market will also have to take into consideration the effective rent, okay? Because you review your leases based on effective rent, not based on headline rents as well. So you have to have this further thinking. Am I going to review this as explicitly on the market rent, and then give a not void, I'm gonna give a rent-free of 6 months, or you're gonna review it based on effective rent and not give the rent-free period or the capex contribution. So this is also questions that will be talked about, that you have to ask your client, the person you are doing the valuation for, is like, what is the lease structure here? And then in terms of capex, as I mentioned, it's also important, because you have to think about, okay, there is going to be voids. What are you going to do with the voids there? Are you going to refurbish? Are you going to refurbish the whole building? What is the market approach to an empty building? Do they just live there and hope for a new tenant to come in, or they will have to use some capex contributions, or they have to do some refurbishment capex in order to get this building relet again? So you have to make these assumptions here. I understand that some valuers will be doing this already, even on an implicit basis. So if you're already doing this, even using the term and reversion, the hardcore method, okay, so you are perhaps one step further in the thinking of, you're going to have capex, you're going to have void costs, you're going to have letting fees, you're going to have your service charges that are not, that there is no tenant there, empty rates. How are you going to deal with empty rates, the void rates? So how are we going to deal with it? And also another problem, not problem, but like another part of the analysis is that, okay, are you going to rent the building straight away after you do the capex, or there's going to be a lease up period? Okay, because if you do, for example, this valuation that you say, okay, if it's empty, it's a vacant possession, I'm gonna adjust the yield by 50 basis points. Now it's going to be, perhaps your clients are gonna ask you more questions. It's like, why is that yield then change from 4% to 4.5%? based on vacant possession? Why is that the difference? Why are you taking out 20% of the value of my building if it is vacant? Then you can, with the DCF, you can pretty much tell the clients that actually there is a lease up period, and here are my assumptions of the lease up. Okay. Right. And then in red here, what I have put is the discount rate and the exit yield. The reason why I put in red is that because the values are going to be very sensitive. What do I mean by sensitive? The small change in discount rate and a small change in exit yields will have a big impact on the value of the building in question. Okay, so we need to be extra careful with this discount rate and exit yield, where they're coming from, how are we going to justify, how are we going to make sure that it is as clarified as you could. So therefore, these are my red inputs here, because these are very important when we're doing the valuation, and we have to know, we have to have confidence, that conviction that we are in the right path. Okay. Okay, just before I go to the modeling itself, so we're gonna do a quick valuation here on the building. Just want to say that if you want to come to my course in January, so I'm running this very quick sale here, 50% discount for the course in January. So it's January only. And if you like to do it, then please do reach out. So it's info@cambridgerefinance.com. Okay, and it's a 5-day course, but you can do like in modules, 2 days or for 3 days, and I'm happy to have a conversation. So don't miss the opportunity. If you want to know more about the DCF valuations, please do come to the course, and actually how to model it and how to actually come up with a value. Okay, right, so this is the presentation. Now what I want to do is talk about a specific case study. Okay, the case study here is a building called 8 Bovary Street. So let's pretend you have to do the valuation of this building. How would you go about it? It is a single let freehold income opportunity. Again, it's an income opportunity, therefore DCF is appropriate. The opportunity here is in the City of London, so you can read here. What is important from a valuation perspective? What is important here in this part is that you have a passing rent of 2.3 million per annum, equating to a low overall rent of 48.75 pounds per square foot, reflecting a substantial discount to prime rent. Well, this is the brochure for sale. So it is your task is, okay, what does this 48.75 pounds per square foot actually mean? The tenant here is Euromoney institutional investors. So what we need to do from a valuation perspective is we need to do the DCF of the income, so the discounting the cash flow. So let's look a little bit further on the tenancy schedule. I'm just gonna search here, tenancy. So here, the tenancy schedule is that you have 8 Bovary Street is single let to Tipo Limited, a wholly owned subsidiary of Euromoney. Euromoney is a listed company, is a PLC. Okay, so you should have strong covenant on a lease expiring on 29th of May 2029, providing a 6.3 years unexpired certain term. This is a little bit, now it's a little bit shorter than 6.3 years, but nevertheless, the expiry is on the 29th of May 2029. It is a rent review upward only to market rent, so upward only, which means that it might be that the rent is going to be 2.3 million up until 29. Okay, if you were doing just like the normal all risks yields, you would just divide the 2.3 million by a yield that you get from somewhere. But now we have to think a little bit further out, because you have to think, okay, it's going to be upward only, fine. When is going to be upward only? Because it might be that the next review is still 2.3 million, but then the review after might be might be reviewed to market. Actually, in this case, the next rent review is 2024. And then expiring 2029. So it might be that you only see there's only one rent review that you're going to have in this tenancy schedule. Okay, so this is the case study. So how would you go about doing the inputs? So let me just the inputs here. So I have this model here. Again, if you want to find out how to build up this model from scratch, happy to have you in my course. But here, what I'm going to do is just show you what the inputs that we're going to need to do a pro forma cash flow so we provide a DCF valuation. So it is a pro forma because, of course, pro forma means it's going to be a forecast of what the income is going to be and what is going to be the expenses and the expenditures, capital expenditures as well. The rent, so there is another question here. Is the rent gross rent? No, the rent is FRI rent. It doesn't say here, but it is next. It doesn't say specifically, but normally it is on a FRI, basis, triple net basis. Okay. Okay, so what are the inputs that we need? Oh, what I also need in terms of inputs is the thinking about, I didn't put it here, but it's thinking about the holding period, right? Because in the implicit valuation method, the ORIS yield, there was no problem with the holding period. The holding period was always in perpetuity, therefore, don't need to think about holding period. Now we have to start thinking about what is going to be the holding period of this property. From a valuation perspective, normally what I do is that I try to look at two sets of rent of lease event. What do I mean? So if the next lease event is going to be like, what is going to happen in the next lease event? So the next lease event is going to be a review. So we know that it's going to be a review here because that's what they said in terms of review here. So it's going to be a review in 24. So that's the first lease event. Then the next lease event is going to be the expiry. Okay, it's going to be the expiry in 2029. Therefore, what I need to find out is, okay, so after the expiry, do I just assume that it's going to be sold at vacant possession? Even if it's sold at vacant possession, what will be the next buyer paying for this vacant possession? And that's also like the whole thinking around, what is the market value? Because at the end, you should be able to achieve a sale price, okay? So normally what we do here is, what I do is I say, okay, my holding period is around 10 years, because in 10 years, I should be able to see and to remain consistent with my approach of holding periods of valuations. I should be able to analyze two sets of lease events, okay? And that's why I say, okay, put 10 years, because if you have a 5-year rent reviews, at least you can see the two cycles of lease events. So in this case, it's going to be the cycle of one rent review, and the other cycle is going to be the expire, what's going to happen expiring. The target rate. So this is the main question that we asked. A target rate, it's one thing that we are not really publishing, but we're just going to, but what we have here is historic values on what was the risk premium of properties in the UK. Okay, it is a big assumption, I understand, but what we need to do is now start thinking about, okay, this target rate, how is it composed? Is it part of a risk-free rate and a market risk premium and an asset risk premium? Therefore, we need to start thinking about what is the risk-free rate and what is this risk premium on an asset basis and on a market basis, okay? I put there as 8%, and then we think about it. The rental growth, so you could have rental growth, an assumption as well of rental growth. So if you are looking from a market rental growth, you have to get information from, you know, big data providers. Sometimes this information will be broken down year by year. Sometimes you might have just an average over the next 5 years, okay? So you have to also qualify this rental growth. What is it doing? And also don't forget, with this rental growth, you need to take into account if this rental growth is inclusive or exclusive of depreciation. You have to think about an exit rent. So that's not the reversionary rent, but is the exit rent. And this exit rent is explicit rental growth. Okay, so what is the expected rent in the as you're gonna sell it? Exit yield, again, is a very big question that we have, the exit yield. The exit yield should be, some people say like your exit yield is the same as your initial yield. Not necessarily, okay? Because your initial yield should be a function of what's the market's pricing now. Is the market pricing the same? Will your building be exactly the same at the time of sale? And will the market be the same as the time of not sale, but like the end of your holding period? If you're, you know, making assumption that you're gonna hold it forever. Therefore, we need to find the sale price. So the sale price is the same. So you will need a terminal value. You will need an exit cap rate. So it's going to be the rent divided by the cap rate or the yield. And then you also have to think about, you know, the exit yield being gross or net. So in this case, the exit yield, the initial yield is net. Therefore, the exit yield should be net as well. So you need to divide by 1 plus your purchase costs. Assumptions of OPEX as well, assumptions of OPEX, sale cost, and also the refurbishment. What is going to be your refurbishment CapEx and when it's going to, you know, kickstart. Also, the period of your refurbishment will be very important. And then here we have we can find out what is the value of the building by discounting the cash flows. So you're going to discount the cash flows to the present value, okay? And therefore, the present value here is going to be the NCF. The way I calculate it here is that it's the net present value plus the gross value, the initial value here. I'm not going to go through the mathematics of it, but the value here is the present value of all your cash flows. Okay, so 34 million. Now, this is assuming, so I'm just going to finish here, assuming an exit yield of 5%. And then how does it work? It means that your net initial yields, if you're using a discount rate of 8%, your net initial yield is 5.8%. How do you reconcile? Well, the way to reconcile is to make sure that if you're, for example, this is your implicit method, and the gross value here is your rent divided by the yields. So what you need to do is you need to reconcile your NPV with what you think is the net value here on the all risks yield. So that's the way for you to reconcile the NPV with the net initial yield. So if you start with your net initial yield as your true, then you can find the discount rate. But if you have your discount rate as the true that you think, then you can adjust here for your net initial yield. My recommendation always is that you start with your target rate. However, you might want to triangulate this with the net initial yields. Therefore, you need to make sure that this is reconciled. So I'm just going to do an example here of how to reconcile. So say, for example, your exit yield now is not 5%. You want to assume an exit yield of 5.4%, 5.5%. Then what's going to happen? Your value here, 31,743,000, doesn't align with the implicit method with the all risks yield. Therefore, what we do here is that in order for us to reconcile both, we need to just run a goal seek, and then we run the goal seek here, that this cell value here, the net value, is the 31,743,132 if you change the net initial yield. So now, if you change the exit yield, okay, if you change your exit yield from 5 to 5.5, then your net initial yield or your all risks yield becomes 6.26%. Okay, so sorry I overran a little bit, but that's what I wanted to tell you about the DCF, how you know, like the inputs that we have to start thinking about, and also how you go about, you know, like your implicit method with your explicit method and how you reconcile the two. And then we use this kind of simplified tenancy schedule here of 8 Bovary, but it is a building that is there. Your money is the tenant, so you can go in there and see it. So it is happening in real life, and we can use a simple method, a simple cash flow here in order to come up with a value. Okay, so any other questions? Yes, so I hope so Khalid, I hope I answer your questions as well. Happy to circulate the question. If you have more questions, please do send them to me on the, here is my email, mvidna@cambridgeirefinance.com. If you are interested in joining the course in January, don't forget, there is this massive discount that we're running, 50%. I'm going to go bankrupt. I hope not. I hope a lot of you can come to the course. But that's my take from the DCF valuation, that you will need to be confident. You need to have a lot more conviction these days regarding what is the inputs and what is the makeup of the value. Okay, and that will provide a lot more transparency and a lot more robustness to your work as a value. So I hope that's okay. So thank you so very much for attending. Again, if you have any questions, yes, if you have any questions, Tadine, yes, I'll share this with you. And if you have any questions, please let me know, and I'll get back to you. Okay. Thank you so much. I'll see you later. And bye-bye.